Good afternoon, folks. Today I'm going to be touching on 6 eventful news items. Okay, and these are largely going to be artificial intelligence and impact on employment, gold and inflation, which is a bit of a surprise there, the catch-22 situation that banks are facing in India, what's happening to global FDI, and then how our FPI is looking at India. Okay. And the last one is a more heavy one, what's been happening to interest rates across the world. We've had the Fed, the BOE and the BOJ all coming out with their policies. So let's dive into the news. Okay. So the Mint has an article taken from the Wall Street Journal, and this quotes the Amazon CEO Andy Jassy about how AI will lead to eventually a smaller workforce. So he says, as we roll out more generative AI and agents, it should change the way our work is done. It's hard to know exactly where this nets out over time, but in the next few years, we expect that this will reduce our total corporate workforce. So Andy has, of course, said this in a very general term, and really there's no timeline. But whatever the World Economic Forum has found through its survey, it says that about 41% of employers said they would downsize their workforce due to AI. That's a considerable number. Of course, we do not know when this 41% downsizing will happen. More likely it will happen a little bit when we don't really notice it. But over a period of time, we'll see that it's been down by 41%. So all companies ranging from retail to pharma are using AI to perform an increasing number of functions, is what they are saying. Microsoft itself reduced its workforce by about 3% this year. Almost 6,000 employees were laid off. And all these companies, Amazon, all the big tech companies have been continuously laying off in the last few months. And whatever that I have gathered speaking with majors in the tech industry all point to the same, that they are quite keen on using more AI, and that could result in a large reduction in workforce. We know that current hiring is down. We know from previous articles that I've been speaking about that the age profile of our tech companies is going up, not down, which shows that the bottom part of employees are either not being hired or being fired, leaving only with the middle and the upper group to add to the demographics of the company. So there's also a fact here. Nearly 1 in 4 US tech jobs posted so far this year are seeking employees with AI skills as per job listings data. So that should be a pointer that if one wants to be gainfully employed, having skills in AI is a must. And I think this is something that all of us need to take note of. Regardless of which profession we are in, we need to be skilled in using AI tools. The second one was about gold and inflation. No, I'm not talking about gold as an inflation hedge here. Okay, the headline says, surging gold prices driving core inflation higher, says Chrysler. Isn't this strange? Chrysler is saying that as gold is driving inflation higher, and we are accustomed to talking about gold as an inflation hedge. So a fact that maybe many of us were not aware is that in the computation of core inflation, so what is core inflation? So core inflation seeks to cut out the noise from the other retail inflation by removing very volatile components such as food and fuel, and then finding out how the rest of it have been growing. And that is core inflation. A lot of central banks use core inflation as a measure when they're looking at interest rate policies and monetary policies. So here we discover that a component of core inflation is actually gold. And we all know how gold has been going up. So with the rise in gold prices, core inflation is going up. It could be sending out wrong signals, because we know that gold is not either an industrial consumption input nor a personal consumption input. It's more a discretionary input. It's more a inflation hedge. And if we see core inflation going up due to gold, it need not necessarily dictate monetary policy. Let's remember that. And I'm sure the central bankers are well aware of this fact. So in today's newspaper, we have a quote from Jerome Powell, And he's saying, ultimately, the cost of the tariff has to be paid, and some of it will fall on the end consumer. We know that's coming, and we just want to see a little bit of that before we make judgments prematurely. Of course, this is in context of the Fed policy, and the Fed policy was to hold interest rates as they are. They did not reduce them, as has been the calling of President Trump, but the Fed feels that when the tariffs, if and when the tariffs hold, then the prices are definitely going to go up for the US consumer in some form or the other. And to hold inflation, they would want to keep interest. They do not want to reduce interest rates. As you know, when inflation is going higher, the one way to control it is to raise interest rates rather than to be reducing them. So the Fed has been holding on to its stance right from the beginning of the year. And I think they will have to continue doing so till data shows them otherwise. Okay. One, they will have to see the end of the tariff negotiations and then start looking at the data whenever that happens. The other thing that the Fed did is to downgrade US GDP to 1.4% growth only. Okay. That is to be noted. Unemployment is stable, in their words. GDP downgraded, interest rates constant. So while we are looking at the US Fed's policy, the next day the Bank of England also came out with its interest rate policy, and they have also decided to hold interest rates stable. Everybody has the same concern. We do not know what tariffs will do. We do not know what the war will do. We do not know what crude oil will do. So safer than sorry, keep interest rates stable. The one country that has been reducing interest rates, the one country that has been increasing interest rates is the Bank of Japan. Okay, they are already facing a rising inflation, and policy is hawkish, and it's quite likely that they will raise interest rates during the rest of the year to control inflation, and that is going to cause a fair bit of chaos because of the carry trade which I've spoken about earlier. And as interest rates go up for the yen, then the carry trade will unwind more and more quickly if much of it is not already having been unwound. The next headline is catch 22 for banks as interest rates dip. So the dilemma in front of banks is, do we reduce deposit rates? Do we reduce interest rates, lending rates? So they have to, as long as they're connected to the repo rate. Then when the repo rate comes down, as it did in India last week, banks have to adjust their interest rates. Though the deposit rates will come down first, lending rates will come down later. There will be some lag, and this will help them maintain some margins. The point is, if they reduce deposit rates, banks are worried that they may not attract enough deposits to be able to lend money when the credit cycle takes up. Credit cycle is on a downward. We are at a very low growth of about 10% per annum on credit. That's low. Okay. And we had the situation last year when we did not have enough deposits to maintain the credit deposit ratio. So while now it is stable, banks are worried that when the credit offtake actually begins, there will not be enough deposits because the savings rate has dropped in India. Not only has the savings rate dropped, we also see that savers are looking at alternative methods of investment rather than leave them in banks. So one alternative method that has been creeping up is mutual funds. Now, mutual funds are almost 1/3 the size of bank deposits. From way low, way single digit, mutual funds AUM are now almost 1/3 of the size of bank deposits. That is where savers are putting their money. So banks will need to figure out other methods to be able to lend money to borrowers as and when that happens eventually. If they keep deposit rates high to attract enough deposits, then they either have to lend at a higher rate or their profit margins have to reduce. Now, this is a problem. Will they be able to lend at a higher rate? If credit demand is so high, they may just about able to. Otherwise, their profit margins will reduce. So this is the catch-22 that banks are facing, and let's see what happens as we go along. The report from the UN agency, UNCTAD UNCTAD, says that global FDI shrinks again in 2024. Project finance falls by 27%. The report is pretty dismal. It does say that in the calendar year 2024, global FDI fell by 11%. Okay, and if they remove the normalize it for other flows, financial flows, it actually came down by about 2%, which is not great. I mean, global FDI, as long as it is positive and flowing, it helps GDP growth, and especially for developing and emerging markets. So it's this fall in global FDI, one may immediately say it's because of tariffs, but tariffs happened this year and the report is of 2024. So 23-24 were already showing a decline in global FDI because the uncertainty was always going up. We had uncertainty due to China being on the opposite side of tariffs and trade negotiations, the China plus one wanting to but not taking off because of global uncertainty. You had the Ukraine war, you had various other tensions coming up. All of it led to less business decisions being taken to invest. Okay, but the one bright spot in all this is that the Association of Southeast Asian Nations, the ASEAN group, is the one group that actually saw 31% increase. I'm not sorry. The Southeast Asia offered a rare bright spot. The ASEAN bloc attracted a record $225 billion in FDI, up 10% year on year, while the global average was down 11%. So this is more likely because of supply chains moving away from China into what is called connector countries like the ASEAN. Even other EMs are there, like Mexico, which is a connector country, but ASEAN by itself has received a good FDI. So FDI gets impacted whenever there is local policy uncertainty, whenever there is in general global uncertainty. But one thing that the report says, when there is good GDP growth, it will attract FDI. So growth by itself is a magnet, okay, and policy uncertainty is a deterrent. And India, we know, has been doing some flip-flops on FDI policy, on taxation policy, which is possibly constraining more FDI coming into India. But we as a growing country need FDI because this FDI comes in and creates assets, fixed assets, creates manufacturing assets, service assets, business assets. We want FDI to for our own growth. So I think it is the ball is in the government's court to give a good enough policy environment for foreign investors to come in. Okay, so while we were glooming up about FDI, even FPI, that is not looking good. So the headline says global conflicts temper FPI optimism on India outlook. So we really don't have a problem on the Indian growth story. The problem is the valuations. So the Nifty 50 is trading at a 19.3 times 1 year forward earnings, and that is a high forward PE. So India is demanding too much of a premium for the kind of growth it is offering, and foreign investors are not willing to bite. And in fact, in the month of June, they withdrew 6,200 crores after a positive April and May. So June saw a withdrawal of foreign investors, and that could be not just because of valuations, but because of the Iran-Israel war sparking off, and in general, a gloomy geopolitical situation because of this. And we must remember that India depends a lot on crude oil imports for our energy sufficiency, and any jump in crude oil prices impacts our economy. And crude oil has gone up to almost $73 a barrel, and as of now it is all right, but any more rise would definitely impact our economy. So this is where we also saw during the week gold first rising up because of the conflict, and then falling, and eventually gold ending 1% down, as we see that possibly Iran could come to a negotiated settlement with the US allowing for another 2 weeks before they take a decision to whether to join in the war or not. So it sort of indicates that there's enough room being given for Iran to come and settle. The Nifty 50 ended flat. The S&P 500 and the Nasdaq were down 0.8% and 0.7%. Oil, of course, jumped up a further 8%. The dollar actually strengthened this week by 0.5%. So we've been seeing a weakening dollar for various reasons we've discussed, but the first sign of a global crisis in the form of war, and investors went back to the dollar. It just shows that the world does not have enough safe haven assets, and we will still go back to the dollar to protect our money when it comes to the crunch. Till there are enough alternatives, this will keep happening. So if you see the resolution in the conflict, we may go back to seeing the dollar reverse its strengthening process. But otherwise, yeah, we don't have much alternative to the dollar as far as safe assets go at the moment. We only have so much of gold. We don't have enough of gold in the world to satisfy everybody. So that's it for this week, folks. Thank you.